Welcome back, guys, to part 2 of 10 great dividend stocks in 2019. In today's video, we're going to look at stocks number 6 through number 10. And if you haven't seen part 1 yet, you can find that linked down in the description or on a pinned comment as well. Just a quick little disclaimer, I forgot to mention this last time, but these aren't necessarily like the best or my favorite dividend stocks out there. I'm just trying to give you guys like a wide variety of stocks to look at. So some of these are growth, some of them are value, some are high yielding, some are low yielding, and everything in between. A lot of different industries. So it's just meant to be a fun video to look at some different stocks. But with all that said, let's go ahead and get started. What's up, everybody? My name is Ale and welcome to my world of stocks. Alright, jumping into stock number 6, we've got NextEra Energy, ticker symbol NEE. And this one is a little more risky than you're probably used to, so make sure that you do a lot of research on it. It's actually a new one that I've started researching recently myself, but I haven't bought into it yet because they are already up quite a bit, which we'll take a look at in a second. But this is a renewable energy company, which I do like because I think that's probably where the future is headed in terms of where energy is headed kind of overall. And NextEra is an interesting play on that, given that they're considered the world's largest generator of renewable energy from wind and solar, which is obviously very impressive. Equally impressive is their dividend, which has been increased for 24 straight years, which, by the way, I believe it's actually 25 now, making them eligible for dividend champion status. But even now, they still have a pretty nice yield of 2.6%, a payout ratio that is a little high but still less than 60%, and a double-digit 5-year growth rate. When looking at their stock, they are now up by almost 100% in the past 5 years and are trading near record levels, so this is one of those that I would definitely wait for a big dip before buying in if you can get it. But even at these high levels, their forward PE is still relatively reasonable at around 21. Now, their sales have been a little up and down in the past 4 years, but management has done a great job of turning those sales into profits, with net income climbing every single year and by pretty large amounts in 2017 and 2018. Their latest quarter was also strong as they grew sales by about 6% and adjusted EPS by 12%. And they're not stopping there. They're already investing over $40 billion through 2020 on new projects and infrastructure to ensure that they meet their growth targets of 6 to 8% compound annual growth of adjusted EPS through 2021, which obviously would help fuel additional dividend increases in the future. And I'm inclined to believe the growth can continue, given that the advanced energy market, which is mostly comprised of clean energy, is already worth over $200 billion in the US and $1.6 trillion worldwide. That's up by hundreds of billions of dollars from just a couple years ago. And there's not many reasons to think that this growth shouldn't continue as the world becomes more and more concerned over the environment. Alright, guys, moving on to stock number 7, we'll go with a fan favorite and much less risky stock with Apple, ticker symbol AAPL. Now, I'm not invested in them myself, but in my opinion, Apple doesn't get nearly enough attention for their dividends since they only recently started growing them, but I actually think that this could turn into a very nice dividend growth stock for the long term. They currently have a yield of around 1.5%, which isn't very high, but that's with a very low payout ratio of just around 25%, so they have plenty of room to grow that dividend in the future. By the way, I'll link my dividend growth investing video in the description in case you want to learn more about the power of dividend growth investing, and it's actually one of the most popular videos on the channel. But going back to Apple here, they have a double-digit 5-year growth rate and 6 years of consecutive growth. I know 6 years doesn't seem like a whole lot, but again, this is a dividend that has grown every single year since they recently started growing it. Now, as a stock, they've been a little more volatile lately, but they're still up about 137% in the past 5 years, and when looking more recently at the past year, they had a huge dip towards the end of 2018 because of weaker iPhone sales and a general market correction, but thanks to higher sales and services, the stock has really started to rally in 2019 as investors continue to regain faith in the company and are so far up over 27% this year alone. By the way, they're about to announce earnings for the first quarter of 2019. It'll probably be out by the time this video is uploaded, so you should check to see if the stock has dipped a little, which would leave it at a more attractive price and obviously dividend yield. But even at these levels, they trade at just a 15 forward PE ratio, which I think is pretty cheap considering how strong their business is. You can't forget that this is a company that did about $266 billion in sales last year alone. That's literally hundreds of billions of dollars, and they've been very good at converting those sales into profits, with about $60 billion coming in as net income, again, just last year alone. Not to mention that their balance sheet continues to get larger and larger, with over $130 billion in current assets and a monstrous $365 billion in total assets, which, by the way, a lot of that is actually cash and cash equivalents, which they can use to invest in future growth prospects, and that's exactly what they're doing with Apple TV and autonomous driving. Not to mention that the upcoming 5G kind of technological revolution, or whatever you want to call it, should help Apple boost their sales even further in the mid to kind of long term. All right, moving on to stock number 8. Now, if you're looking for a decent yielding dividend stock that has been absolutely destroyed by Wall Street, one that I find very interesting right now is CVS Health, ticker symbol CVS. You've probably heard of them. They're mostly known for their retail pharmaceutical stores, but they also offer health insurance services, and they recently acquired Aetna, which is one of the biggest health insurers out there, so the cost synergies from the acquisition should result in about $750 million in savings by next year. Not to mention that they're already the pharmacy of Target, and their partnership continues to grow as Target will now be shipping CVS prescriptions to customers across the country through their Shipt subsidiary that was recently acquired as well. And by the way, CVS is also starting to sell CBD products across the country, which happens to be a market that I am extremely bullish on for the long term. In any case, new competition from threats like Amazon, along with the fear of disrupting changes in the market like Medicare for All and drug price reform, have scared investors into deserting the stock, causing it to drop by almost 50% in the past 3 years, and already down over 17% in 2019, and recently hitting a new 52-week low. Still, sales have actually increased by billions of dollars in the past 4 years, almost reaching an enormous $200 billion last year alone. Profits were also doing very well up until last year, where they plummeted to negative $600 million, which was mostly due to an impairment charge. Obviously, that shouldn't be taken lightly, but their non-GAAP measure of free cash flow was still pretty high at almost $7 billion for a year-over-year increase of around 7.5%. Their guidance for 2019 is also looking pretty strong, with the top of their ranges seeing GAAP operating income of $12.1 billion, non-GAAP at $15.2 billion, GAAP EPS of $5.08, non-GAAP at $6.68, and cash flow from operations at around $10 billion. In any case, their valuation is pretty cheap at the moment, with a forward PE ratio of just 7.5, a PEG of less than 1, a PS of 0.36, and they're trading at just around 20% above their book value. Couple this with a solid dividend, and you have a pretty interesting stock that yields over 3.7%, has a payout ratio of less than 30%, and a 5-year growth rate in the double digits. Now, it is true that they have 0 years of growth because they kept it at the same level last year, but it's mostly been trending upwards overall for decades. So I do actually consider this a pretty good dividend growth stock as well. By the way, just like Apple, they too have earnings coming up, and it'll probably be out by the time this video is uploaded. So make sure you check back to see if the stock took a bigger dip, in which case that dividend may be yielding an even higher percentage now. Alright guys, and that brings us to stock number 9. And for this one, we'll go with another stock that Wall Street has been pretty negative on, and that's International Paper, ticker symbol IP. Now this is mostly a paper and packaging company, so they're actually a pretty big indirect play on the international shipping and online shopping markets, which we'll take a closer look at in a second. But when looking at their stock in the past 5 years, they've gone up and down by pretty significant amounts, but ultimately ended the time period relatively flat, only up about 2%. More recently, however, they've dropped by almost 30% since their highs in 2018. A lot of this had to do with negativity surrounding the whole trade fight between the US and China, and how that might impact their business and send their sales plummeting. But here we are well into 2019, and IP hasn't really seen any significant impacts from those tariffs and the overall trade dispute. In fact, sales have actually gone up. Each of their different segments saw revenues increase in 2018, with net sales rising by 7% for the year. Even their profits grew, with total business segment operating profit growing by almost 40%. Now, their last reported quarter wasn't nearly as impressive, with sales being relatively flat year over year, but you have to keep in mind the context of Wall Street expecting this to be more of a sinking ship rather than one that continues to cruise along. They even grew their free cash flow by over 150%, something that I don't think any investor was expecting. And I'm not saying that they won't see any struggles in the short term. I actually do think that we will probably have some negative impacts from kind of the global kind of slowing down economy and especially China's weakness as well. But looking out in the long term, you got to figure that a trade deal will be done with China. Europe and China's economies will eventually start to recover. And on top of that, the packaging market is well positioned for growth given that the world is becoming more globalized every day and the e-commerce market is still in its infancy, with less than 12% of retail last year being done online, and even by 2021 it's still expected to be less than 18%. Keep in mind that the global e-commerce market is projected to be worth over $3 trillion already and should reach nearly $5 trillion by 2021. That's not a direct comparison into what the packaging market is, but it just kind of shows how much it's growing and by such large amounts. So that's kind of why I compare it there. And even with the rise of environmentalism, IP is still in a good position business-wise, as a large portion of their business is heavily involved in offering recycled products. Still, the negative outlook from Wall Street has left them with a pretty attractive valuation of just an 11 trailing PE ratio, a forward PE of 9, and a really low PEG ratio of just 0.58. Their dividend has also benefited from the drop, giving them a yield of over 4.3%. Their 5-year growth rate is very low at just 3%, but their payout ratio is also pretty low at just 38%, and they have nearly a decade of consistently growing those dividends. By the way, that dividend has also been paid for decades now, but it was severely cut during the last recession. So if you're someone who is worried about the next recession and how that might impact one of your dividend investments, then you may want to think twice before investing in a company like this, because their dividend will probably be hit if we go into a major recession. Alright guys, last but not least, for stock number 10, we've got my second largest stock in my entire portfolio and my overall favorite dividend growth stock in the market, and that's Microsoft, ticker symbol MSFT. And they're obviously well known for their Windows, Office, Xbox, Surface, artificial intelligence, and cloud computing products and services. Now at the moment, their stock is very high, no way of sugarcoating that, so I would really consider waiting for an overall market pullback or even just kind of a pullback with the stock itself. But before making any kind of large investment here, you should really think twice, because this is a stock that has reached an all-time high recently and was briefly trading at a market cap of over $1 trillion. I'm not saying that it can't continue its bull run, but I'm just saying that, you should be a little cautious here. I like to buy stocks when they're going down, not so much when they're going up. But in the past 5 years, the stock is up by 225% and over 27% in 2019 alone. Still, even at these levels, this remains one of the best performing companies in the world, with a very nice dividend and a valuation that, in my opinion, should probably be even higher considering what you're getting in return. Now, they currently have a trailing PE ratio of around 28 and a forward PE of 25, and when looking at their dividend, the yield is pretty low at just 1.4% yield, but their payout ratio is also pretty solid at 43%. Their 5-year growth rate is in the double digits at over 12%, and they have 16 straight years of consecutively growing out that dividend. And in my opinion, that dividend will keep growing for a very long time, considering the fact that this is practically a $1 trillion company that still keeps growing their sales like a company that just barely went public. In fact, in their last quarter, sales grew year over year by double digits at around 14%. That's pretty crazy, again, considering it's like a $1 trillion market cap company. Efficiency continues to improve as well, as operating income grew by 25%, net income by 19%, and EPS by 20%. These strong results were primarily driven by their intelligent cloud segment that includes Microsoft Azure, which jumped by over 20% year over year. And if we break down these results even further, we can see that an alarming number of their different products and services saw double-digit growth as well, with some of the clear standouts being Office 365 at 30%, LinkedIn at 27%, which by the way they just recently acquired them not too long ago, Dynamics 365 at 43%, server products and cloud services at 26%, and Surface at 21%. It's pretty impressive considering Surface, a lot of people were bearish on the whole Surface product lineup in the past, but it continues to perform pretty well. But in any case, the real star of the show is again Microsoft Azure, their massive cloud computing platform and infrastructure and services, and that grew by a massive 73%. Alright guys, I think that just about does it for today's video. What did you think about these stocks? Let me know in the comment section down below. And are there any dividend stocks that you guys like more? One that I saw commented a lot recently across several of my videos was waste management, and I was going to include it, but I ended up not including it. Another one was 3M. That was another one that a lot of you mentioned as well. They have a huge history. I think it's been like over 60 years that they've increased their dividends, so it's been like decades and decades, and I think 3M has paid dividends for like over a century too, so that's kind of an interesting one as well, but I've just never invested in them. They're famous for like making post-it notes and things like that. It's just not really a market that I don't know, I just don't find it like that exciting and stuff. But they do other stuff as well. They do other technologies and healthcare and different things too, but in terms of products for that stuff. Anyway, I'm going off on a rant. Thank you for watching. Let me know what you think down below. Any dividend stocks you like, leave them down below. And I guess I'll catch you guys in the next one. Hit the like button if you enjoyed the video. Thank you for the support. Take care. Bye-bye.